Yeah, so the reason why I want to make this to be general is because of what we are going to be discussing today. And what we'll be discussing is has to do with some of the things that lots of traders used to um, do go through while trading. A lot of traders go through all these problems, and I feel that, you know, one way or the other, let me just try to make it free so that even those that are not able to be part of the those that are not able to be part of the training can at least still have some benefit. Then they can also try to correct the way they view the market. So yesterday we talked about the institutional trading techniques, and I gave you guys some of the indicators for you to install, the pivot levels and the volume. And I believe you guys have already started going through them and backtesting them to see how good they are. But today we are not going to be talking about anything apart from the psychology of trading, risk management, money management, and trading psychology. So I don't know if we are complete in the house yet. If we are complete, then I can start. If we are not complete, then maybe I wait. But I feel I should just start straight up. So today we'll be talking about the pro trading course. We've been going through this training session since October, and we've learned a whole lot of things, starting from the beginner course to the candlestick formation, to the chart patterns, Elliott wave. We discussed extensively of Elliott wave, then market structure, then harmonic patterns, pivot level, a whole lot of things that we have discussed. So right now it is assumed that you already have the knowledge, but everything does not finish with the knowledge. As a matter of fact, knowledge is one part of what you need in trading. The other part is discipline and trading psychology, which we are going to be discussing today. And most importantly, the money management and risk management, which some of you guys used to ignore. And by the time we go through today's training, you'll be able to now realize what you have been doing wrong all this while, and perhaps going forward, you'll be better off. So this is just the introduction to the pro trading course, which is what I'm doing right now. Then after that, we'll be looking at trading psychology. Then we'll also try to discuss why you should not be results oriented. Then I'm going to give you a little brief about profit management, then loss management. Then later on, we go to money management and risk management techniques. So that is where I will stop for where I will stop the class for those that are going to be joining us free. I'm just going to be discussing all this 1 to 6. But for the geometrical trading system, where we combine harmonic and Elliott wave structures together, I will have to send you guys a new link where you join later on by the time I end this class with those that are not part of the batch. But what I wanted to do before was just to make the people that are free to be on YouTube, then those that are paid on Zoom. But because I couldn't connect the Zoom to YouTube right now, so that's why I decided to just combine every one of you to Zoom. So we discussed the geometrical trading system later on, and then edging techniques. So primarily what we are going to be discussing today are just this. If time permits me, then I may still discuss this today. But if I'm not able to discuss this today, we'll be discussing it in the next class. I don't know whether we are going to be having a class before the end of the year or probably next Saturday. But after that, we just have one more session, and we are going to be ending our training session. Then you guys can now focus on watching the videos all over again, putting everything together, and going to practice some of the things that you've learned. And if you have questions in the group, you can chat me up at any time. I'll be willing to attend to you. So let's start. Trading psychology. Now, you need to exhibit the right approach and mindset to trading the financial market when you are sitting in front of a chart. The first and most important thing that you need to first have is the knowledge. Then after the knowledge comes the trading psychology. Then after that comes disciplines as regards risk following risk management and money management. So everything does not has to do with you just knowing that, okay, this is shoulder or channel or whatever. No, there are some times that you'll be looking at a trade and you are going to even be scared of taking that trade because you are still not confident enough. So the first and most important thing about all this thing is your mindset. You need to first approach the market with the right frame of mind. If you are not going to if you are not in the right frame of mind, that means if something is bothering you, maybe psychologically, you are not stable, or you have a matrimonial problem, maybe your wife or your husband or whatsoever, you are not supposed to go and trade the financial markets at that time. You should try to avoid it because it's going to blow your vision into thinking properly to take the right trading decision. So it's best for you to just ignore, avoid trading during those periods. Now, you also need to see beyond the chart and understand the reasons behind the chart. When we were discussing, during the time that we were discussing institutional trading techniques, which was, I think, last training, I let you understand that the chart does not just move anyhow. There are reasons why they move, and it is because markets you do form structures, and the smart money trade based on those structures. So your ability to be able to see those structures and the reason why they are taking them is what you should be considering when you want to take a trade. You're not just supposed to be looking at the chart and saying because you see a candle, that just do this and do this, does not mean that price is actually moving up. It can actually be, we discussed this yesterday, it can actually be that they are trapping people to think that it is going up, so that after some time, it eventually now start going down. So you are not just going to be looking at the chart. You are going to understand the reasons why those structures are forming. And if they don't form in line with your trading strategy or with the structure that you are expecting, then you just ignore. You are not supposed to take all the setups you are looking in front of you. There are a lot of setups in the Forex market, and sometimes some of them are not going to be in good shape for you to trade. So you leave them, you go to the ones that you know that they are actually very good setup. Those are the ones you're supposed to focus on. Now, having the right mindset means having control over your emotions. So what you are talking about, what I'm discussing right now here is your psychology to trading. And the psychology to trading starts first with the mindset. If you don't have control over your mindset, over your emotions, then it becomes more problem. For instance, you just took the first or second trade, and you are in a loss position. That ultimately can create imbalances, and you start fighting the market. We are going to see that scenario. So the first and most important thing is that you are going to first assume or take it to be that the trading capital you have is already lost. That's the first thing. I've had this discussion with some people. If they want me to help them to trade, and I'll ask them, have you considered that this money is gone? And they will say, bros, I don't want to lose this money. Well, unfortunately, I won't be under pressure. And that's the way you're supposed to view the markets too. We are going to be looking at how you are going to approach with the right account size. But for now, let's try to understand the trading psychology. Okay, someone is raising up his hand. Let me try to find out what the problem is. Yeah, hello, Samia, what's the problem? Hello? Hello? Okay, I guess the person just so let me continue. So you have the right mindset, and having the right mindset means you're going to be able to control your emotions. You don't just take trades anyhow. You have to have a reason before taking any trade. So you need to be disciplined, cool-headed, and always in control of your game. Each time that you're in front of the system, see yourself as a professional. And professionals don't take trades anyhow. They have the reason before they take the trade, and they are very disciplined. Some of the disciplines are what we are going to be discussing today. So after mastering all this setup that I've given you guys, you now need to be on top of your game, and you need to be disciplined, which is why this course, which is what this course focuses on. Now, losing control of your emotion can influence you into making rational. I've already talked about this before. So some of the things that can influence your trading performance or your psychology are fear, greed, anger, or revenge, or overconfidence. So we are going to be looking at these instances one after the other, especially the fact that you just finished getting the knowledge and you want to start approaching the market. The first and most of all the problems you are going to be facing is fear. Then after some time, you start getting greedy. Then after some time, you start losing control of your mind, and anger trading starts coming in. Then later on, when by the time you become so pro level, then overconfidence also comes in. Those things are what will create imbalances anytime you are trading. So the most important thing of all is that you need to trust your trading system, even when you get it wrong. There's no 100% holy grail trading system in the whole world. Sometimes the market condition that you are as at that time does not support the market condition as at that time. It may not support the trading system, but it doesn't mean the trading system is wrong. It only means that, okay, for that period, it is not actually doing what it's supposed to do. But if you are consistent in applying your trading strategy, and the first thing that we learned when we started this course is having your creating your trading plan. So if you create your trading plan and you stick strictly to your trading plan at every particular point in time, then over the period you're going to be experiencing growth. But if you keep on going from one system to the other, inconsistency follows, and you're not going to be achieving that growth. So you need to trust your trading system, and that is when you can get over the fear and over the greed and over the anger, all these things that that I already highlighted above. So let's look at the first scenario, fear. Now, fear is the first and one of the greatest challenge a newbie would face and fight to overcome, and which is very, it's very logical that you're going to be experiencing that because you are still not sure. But over the time, you are going to get over them. So you don't worry. Every pro trader was once a newbie too, and we were once afraid of the market. But after some time, we got over that. So you too will get it. So a trader who exhibits fear does not trust his instinct and closes profitable trades too early in small profits, or at times even closes it in small loss, and at the end, only to see market move significantly in its favor. So this has happened to me several times, and I'm sure it has happened to a whole lot of you guys too several times. And we are going to see how this usually come into play. So let's say, for instance, this is what market has done. You are looking at this market, you are analyzing this market because you want to go long. You want to you want to buy this pair. Based on the structure that you have seen right now, let's say, for instance, you analyze this market and you could see a triple bottom. So as a result of that, you created that, okay, this is the neckline. Then if price is going to be breaking above this neckline, you want to buy it, which is a very good attempt. So you drew the trend line and you now have this candle that is breaking above the trend line. So you feel, okay, I think I'm getting it right. So you are going to be setting your entry around this spot that you want to trade this breakout, and you're going to be putting your stop loss below the candles, this candle that is breaking the old trend line out. Because if price comes back into that same trend line and into this structure, then it means that the old structure that you're considering is no more valid. So your thinking is right, the trade idea is right. The market, then you set your targets to this level. Okay, when you enter the market at this price, you're going to be taking your targets around this place, which is also very fantastic. So yes, price actually broke out, it triggered your entry, and you are in profit. Then all of a sudden, it started moving against your entry. Now, out of panic, you eventually closed this entry because you feel that it is going to now go to touch your stop loss, and as a result, you were scared. You actually now close it in loss. Now, this happens several times, and the truth of the matter is, the best way to trade this kind of structure is to first wait for this pullback. If you remember when I was discussing with you guys on the Elliott wave count, this would have actually been your wave 1 and wave 2. Then this would have been your wave 3. So you have been entering you took your entry in the middle of wave 3, and it is very essential for wave 4 to form a retracement around wave 1 before price eventually start going for wave 5. But let's say, for instance, you are forgetting the structure or you are not confident enough, then this is eventually what happened. You close it out of fear, then after some time, price then started going in your favor. So you eventually lost all this amount of pips on the table. You left it on the table. This will have ultimately be the 1, 2, 3, 4, 5 that I told you guys. So sometimes when you enter when you took some position, it doesn't mean you are wrong. And market is going to actually play on your emotions. They are going to play on your emotions, and each and every particular point in time, this is going to be happening. Price is going to come back to come and test your entry, and sometimes it can even start going against you. But if you understand the structure that you took before you enter the trade, and you still realize that price have not broken below that structure, this structure right now is going to be broken if price had come into this area and closed below this trend line, invalidating wave 1, because the rule of the Elliott wave count is that if it's not a diagonal structure, then wave 4 should not overlap wave 1. So price have not even gotten to the territory of wave 1 as to either break it or reject it, and you are closing it out of fear. So, which is why it's important that you focus more on the structure and the invalidation area, and don't close your trades out of fear. Now, the second scenario you'll be facing as a pro trader that you're not becoming right now is greed. Now, because I've given you guys some of the tactics, we've gone through a whole lot of trainings together and all that, then after some time you start, experiencing some good trade setups going in your favor and all that. Before you know it, you start experiencing this. So this is the second challenge you will face as a newbie. As an amateur or even intermediate level trader, we do think we can squeeze more money out of the market and eventually remove our predetermined target level. So this is what, let's look at that scenario. This is what you have looked at in the market, and when you analyze this structure, you'll feel that, okay, price is supposed to go in your favor, like you want to buy this market right now. So your analysis was based on this. Price was moving up in this manner. Then after that, it formed something that will let you know that here is going to be a tested resistance that is now going to be tested as support. Went up, then came down, couldn't break that level, went up again and came down, still couldn't break that level. So it gives you a very good, nice structure for you to go long. As a matter of fact, this will have been the flat correction that I explained to you guys in the training session. So when you see this, you decide that, okay, you're going to be going long from this spot, from the C point. So your entry was here, and your stop loss ideally is supposed to be below this zone, because if price breaks this line and go into this territory, then this structure is no longer valid, and we don't want to be in the trade. So you took that entry from that spot, and price actually went in your favor. So you were taking this to be, this is where you are going to put your target. This essentially was where you wanted to put your target. Remember, I told you guys that you are going to be taking your targets. If you are trading a flat correction, you're going to be taking half of your position when price hits here, because you don't know if it's going to be forming a complex structure later on. So instead of you to close half of your position as at that point, or at least close half of your position and move your stop loss to break even, you decide to remove your targets totally, and you feel that price is supposed to start doing this. You feel this is what's supposed to keep on happening in the market, something like this. Then all of a sudden, so that was where your target should be. Then all of a sudden, price eventually started retracing, and it retraced back to the entry point, and even in fact triggered your stop loss. So sometimes you don't let greed have control over you. What you need to do in this scenario is to just move your stop loss to break even and close half of a position when price gets to this zone, so that if it's coming back to take you out of entry, at least you have been able to take something from the market. So as a good trading idea then becomes a sad loss, erasing all profits we are initially blessed with, and we don't want this to happen. So as a pro trader, we need to know what we are doing and not to be too confident about the market. You are not the one that owns the market. The market is not controlled by anybody, and anything can happen at any time in the market. Now, the third one is anger, and this is the worst of them all. This sole scenario is what usually causes a whole lot of people to crash their account in one single day. They find themselves in a loss position at a time, and they feel that they can quickly get their money back. And before they know it, they just keep on adding salt to injury and lighting themselves up with petrol and setting themselves up on fire. So this is often the most common challenge encountered by the amateurs and also some intermediate traders, and it happens quite a lot of time. Anger trading occurs when price moves against us. Our emotions then override our thinking. You're not able to think well anymore because you can't see yourself losing that money. And the first rule in Forex is that when you are trading, you are supposed to assume that you've already lost that amount. Now, it does not mean that you are going to lose it, but it's the essence of that is to reduce your emotion, for you to be able to have control over your emotions. When you are trading with an amount that you know that, okay, if you lose this, then, well, it doesn't really matter. It's not my life saving and all that. Then you are able to have very good thinking about the market, making rational decisions. But if you are going to be taking trades, if you are going to be if you start trading the market with your life saving, for instance, just one loss, which is ideal sometimes, just one loss will eventually throw you out of emotions and you start fighting the market. Ultimately, you are going to lose that account. So that is what usually happens. This is the scenario we are looking at right now. You study this market and you feel that, okay, if price is going to be rejecting this zone, I will be selling it. So for instance, this is what would have happened in this kind of market scenario. Price have done this and have done this. So you feel that price is going to keep on going down. Now, you remember that I told you that your first instinct sometimes is usually right. You just need to stick to your trading plan. So you took a sell around that spot, and unfortunately, after you took the sell and price started going in your favor, it reversed significantly against you. Now, sometimes when you are trading, you don't know what could happen in market. This kind of move sometimes can actually be fundamentals. Maybe there was a news release, a report, news or whatever that triggered this move to the upside, and you started panicking from there. So you now feel that, okay, now that the price have broken above this structure, then what you want to do from that spot is to buy if it doesn't break below this level. Now you realize that you have not really done good thinking right here. The first scenario was that you were looking at this scenario to sell. Then when you saw that this broke, as a result of this breaking out, that made you to start thinking of buying. Then all of a sudden, after you bought at this point, price eventually started going against you, right back into the place where you started selling from initially. So you got confused and you now decide to do another scenario that, okay, if price does not break above this level, then it means it wants to go down. So you now decide that you are going to be selling from that spot, going back to your original scenario. Then this happened. Price came down and went up with this gap and went up again. Now, what you are doing right now is that you are chasing the market. You are chasing price up and down. And it is because of just one single trade that you just lost in this area that have made you to keep on losing and keep on losing. But if you have accepted your loss as at this point and you focus on your equity curve, there are some other trades that are going to be in profit, while some other trades are going to be in loss. So what you are eventually do is to concentrate on just one single position and keep on chasing price up and down. You eventually get knocked out. So later on, you now decide that, okay, I think this thing is going to go up because now it has now gotten back to that same level that I want to buy from before. So now I am right. I think it should go up. So you enter buy from that spot again. Then price, did this, went in a little bit in your favor, then all of a sudden it crashed. It actually went down. Now, this is a very terrible mess, and it happens a lot of time to a lot of Forex traders, especially newbie and even the intermediate traders. So you don't want this to happen when you are trading. When you have gained the knowledge about the market, you want to stick to what you know. And as time goes on, in this same today, I'm going to let you see how you would have approached this without really getting messed up by chasing and revenge trading. So this action has led to many accounts being wiped out. Now, what I was explaining in the previous scenario, in the previous slide, is not being one single trade result oriented. That means you are not supposed to focus on just one currency pair and try to make sure you don't lose it. No, that is not how professionals approach the market. A professional approach the market by focusing on the equity curve. It doesn't really care about what each particular trade is doing, which is the reason why. Is this video stop for everyone, or is just for me? Perhaps it's just you. Is anybody having any problem anymore over there? Okay, so I guess it's just try to fix it. So, which is the reason why, if you realize that on the website that I'm building right now, the website will soon be completed. The motto right there is actually bear or bull, we don't care. So that means we are not focusing on one single pair, whether it's going up or it's going down. No, that's not our primary goal. Our primary goal is to actually focus on money management and risk management and the equity curve. Those are the three important things that you need to focus on. As far as you are going to be focusing on those three things, then you are not going to be bothering yourself about a single position in a loss that you're experiencing in the loss, which is why we say bear or bull, we don't care. So you never be single result focused. Focusing on the result of every single trade will significantly increase your emotions and might make you do very stupid things. So that means anytime that you are losing at just one single trade, the result of it is that you are going to be revenge trading. It will let you be to revenge trading, and we already saw the result of revenge trading. Revenge trading can ultimately crash your account, because what you are going to do later on is that perhaps you start with 0.1, you were in a loss, you close it in loss after some time, you started the martingale effect 0.2, before you know it, you are using 1.0 on an account of $2,000, for instance. This kind of trading is actually going to wipe your account later on. So you don't want that scenario happening to you. It will blow your rational thinking and subsequently affect the overall growth of your equity. The result of it all is that your equity will start shrinking. And it is because you are not thinking rationally anymore. You don't have controls over your emotions anymore. You have now started doing stupid things, and you don't want that to happen to you. So the outcome of a single trade does not score a professional trader at all. Sometimes, and as a matter of fact, losing is part of the game. So the outcome of trading period is what matters. You can then measure yourself maybe after a trading week or after a trading month, but not after a trading day or just the result of one single trade. So you want to make sure that that does not happen. Now, by looking at the big picture, you will focus on what really matters. Maximum drawdown over the period. That means if you have not gotten to the maximum drawdown of your portfolio, then you shouldn't really be worried. The only time you can worry is when the drawdown have gotten to your tolerable level. So, for instance, you are trading with $2,000, and you have told yourself that if I'm not going to panic, you are supposed to know how much you are at what level will you start panicking. So you can decide that, okay, anytime if I get to $400, if I start losing $400 out of this $2,000, then I will start panicking. So with that, 400 divided by 2,000. Can anybody help us out? 400 divided by 2,000. What's the calculation to that? Mathematicians in the house. Nobody's helping us out. Anyway, it is 20%. So that means you have decided that the maximum amount you are going to be having at any part. That means your maximum drawdown is 20%. So with that, if price have still not gotten to that 20%, then you're not supposed to fret. You're not supposed to start shaking. So we are going to decide, we are going to still be looking at how you will get to know when price have gotten to that 20%. But for now, what we want to focus on is that you're not supposed to be single trade result oriented. And it's even a very, very terrible, a very bad way of trading. For instance, let me try to show you something. Now, if you have been following my setup, you realize that sometimes I used to post this this kind of table. Now, if you look at it right now, you see that USD card was in loss and New Zealand card was in loss. So if you are trying to focus on those ones that are just in loss, it may eventually start affecting those ones that are in profit. But as a matter of fact, if you look at the risk around this level is just 14%, and you are still in profit of around 29%. So if you now keep on trying to make sure that you don't lose anyone, what will eventually happen is that you are going to be losing some of the winning positions that you even have right there. So before I go to profit management and loss management, let us quickly go to, okay, let's flow with the structure of the slide. Then later on, we are going to go to the Excel. Okay, let me quickly go to the Excel so that I try to let you see some of the things I just explained to you right now. Now, I sent this table to you guys. I sent this worksheet to you guys at some time, and it's still the same worksheet. Now, what this model is doing is this. Assuming you want to start trading. Now, the dollar rate is what I put here at 365, which can now be 360. So you are supposed to eventually first put the dollar rate here. If, for instance, you want to estimate how much you have in Naira or how much you have in your own local currency pair, local currency or whatever. Then, based on the strategy that we've talked about all this while, starting from, we've been on this since October, you are supposed to know how much returns you can be making on the average in a month. That means you test your strategy, historical backtesting, to see how much, how effective that strategy is. So let's say, for instance, this strategy is able to give you 20% in a month. But sometimes it can be 50%, sometimes it can be 30%, sometimes it can be loss, it can be minus 22%. It all depends. But we are saying that, okay, if you are going to be looking at the average over a period of 1 year on a consistent basis, what will be the average return? So you can put that here. Some people can take it to be 15, some can take it to be 25, depending on how strong your strategy is. So for you to approach the market in a way as which is not going to affect your emotions, the first thing you need to first do is to try to find out how much money, in your own local terms, how much money do I want to be earning in a month comfortably. So if, for instance, you feel that, okay, if I'm getting 50,000 Naira in a month trading Forex, I think I'm okay. You put the 50,000 here. If I'm getting 200,000 Naira in a month, I think I'm okay. Then you put the 200,000 here. So let's say, for instance, we put it. So sometimes the reason why I built this model was because some people used to come and ask me, how much do I suggest that they trade with? How much capital should they trade the Forex market with? And I find it very difficult to give a suggestion because my own income earnings, for instance, is going to be quite different from your own income earnings. If you are getting 50,000 Naira and you are okay, then there's an amount of capital you should be trading with. For me, for instance, I can put something like 500,000 here. Okay, when I'm getting 500,000 Naira, I'm okay. So ultimately, what the model is going to do is to calculate how much in dollars you are supposed to be trading with, so that over time, when you're making that return, it will ultimately be that 500,000 naira. So what this model now does, what I eventually now did, so let me go back to that 100,000. I think that one is more realistic for many. So what this now did is that I now converted this $100,000 naira to the to dollars. This 100,000 naira to dollars. So it means that on the average in a month, you're expecting to be earning roughly $300. So based on that expected earnings, then you are supposed to have about $2,000 account size, trading account size, out of which 1,100 will be used for the trading, and you're going to be keeping. So let's just say 1,200 will be used for trading, and you're going to be keeping $800 in your reserve, in your broker reserve. You're going to see reasons why we need this reserve later on. But the reason why I've come to this spreadsheet is for you to know that the first thing and most important thing is that you should trade the market using the right account size that fits your own income earnings. So if you want to be earning more, then you're supposed to be putting more into the market. The fact that you're putting more doesn't mean you're going to be earning more if you don't get the right skills and the right trading psychology and all that. That's not what I'm saying. But I'm saying that the first and most important thing is that you trade with the right account size. What most traders, Forex traders, especially the newbies, do is that they fund their account with $500. They fund their account with $500, and they want to be making about this $200 or $300 every month. That is very wrong. As a matter of fact, if you want to be trading with $500 if you want to be earning $500, if you want to be earning this $200 something, you're supposed to be trading with about $2,000, not $500. And what eventually happens is that when you are not making that enough money that meets your expected earnings, you start fighting the market unnecessarily because you just want to make that kind of money out of the market. Then what happens later on? Later on, what happens is that you are going to eventually lose this $500. After some time again, you fund another $300, trying to get about $200 again out of that $300. What can happen again is that you're going to lose that same $300. So why don't you just wait and compound those money that you keep on wasting every time and compound it to the right account size that you're supposed to trade with, and get the right knowledge and skills to trade it instead of just wasting your money every single time. So let's go to profit money. Let's assume that you're actually making profits when you are trading in the Forex market. How are you supposed to handle it? Well, the first thing you need to know is that overconfidence kills. Overconfidence can actually kill your account. So that means that if you are making profits, it's even quite difficult when you are making profits and you don't know how to manage that profit. Then later on, you now find yourself in a loss. It's going to be very terrible. So the first thing and most important thing is that you don't want to be too confident about yourself. Then the second and most important thing is that you must always follow your trading plan. So the fact that you are in the profit right now does not mean that you are going to continually be in profit every time. The most important thing of all is that even when you are in loss at a certain time, you still keep on following your trading plan, which is very important. Your trading plan is what will drive you back into profit at any time. And the next and most important of all is that you are not supposed to enter the first position unless you have carried out due diligence. That means you have done due diligence to find out a very high probability setup that has about 80% chance. We are going to be discussing this in the next class during the geometrical conference trading strategy. Now, what I'm saying is that if you just fund your account, let's say you fund your account with $2,000, the first mistake you are going to be making is to quickly enter the market without really entering with a very good setup. That means the first trade you are going to be taking, on this $2,000 should be one that will first be in profit by the time markets start moving. The reason is because if you start trading and you start losing immediately you start trading, it can ultimately make you lose this $2,000. So even if it's just one or two trades that you want to first take, And those ones are trades that market have been in overextended position. I've taught you guys how to spot an overextended position. So a market that has gone to, that have really been in overextended position, overextended level, will ultimately start giving you profit almost immediately you enter the market. Let me see if I can quickly identify one. Okay, this same market that I'm going to. Okay, USD card. If you remember, we talked about USD card in the last class, and I told you guys to be watching out for the structure, and that most likely we are going to be having an ED around there, and that is what is currently forming. There's a possibility that it's going to keep first go here, then before it eventually start turning. So this is the kind of the trade setup that you want to take when you want to enter the market. You don't want to just enter the market anyhow. You want to enter the kind of market that have moved significantly in one direction. For instance, this one right now, you can see that price have kept on moving in this direction over the period. And there's a high chance that after some time, this structure is going to be broken. This structure that you are seeing is going to be broken, which is what we saw when we went to the weekly time frame, and we saw the structure right here that is going to eventually break later on. We have the similar structure on the weekly time frame. And so something like this is what we are ultimately expecting. So you want to first make sure that you want to get your first trade right. In fact, that is the right word. When you fund your account, you don't just enter any trade. You don't jump in a trade based on the signals or setup that somebody has put in a group. No. You want to wait for a signal that you know and you're very sure that that is going to start going into profit. That is when it builds your confidence to now start trading more profitably, because you know you're in profit and you're actually trading based on the gains that you have made in the market. Now, once you triple your account, you gently withdraw your capital. Now, that's where the overconfidence come in. The overconfidence come in at the time where you you started with $2,000 and now your account is $7,000, but you want it to get to $10,000 so that you can withdraw later on. So what eventually happened is that from this $7,000, it can eventually start going to 5,000. Then before you know it, 4,500. Although it's still going to go to this 10,000, but there are some times that after price have moved significantly to favor you, it can start pulling back to almost your capital level, then start going back in profit again. And the reason is because of how market move. Market move in waves. So if you enter this market right here, for instance, there's a possibility that it's going to first come back for wave 4. And yes, you have already made this profit. Now it's coming back against you because it still wants to go down. So the way to approach the market is that when it has actually, bless you significantly and you are able to triple your account, you just take out your capital. So in this case, you know that, okay, worst case scenario, even if I lose this account, I'm not losing my own money. I'm trading with the earnings that I've gained from the market. Now, you now trade the balance as if you have just funded newly, starting from step 1 to step 4. That means you need to keep on reminding yourself that you don't need to be overconfident. Anything can happen in the market. You go back to your trading plan and you enter high probability setup. You just keep on following that same principle. Once you triple your account again, you withdraw about 50% of that profit. Now, the truth of the matter is, you need to always remember the poor when you are making profits. When you are going on the street and some people, ask you for money, or some of your family members or whatsoever, somebody is asking money online or whatever, try to help the best way you can. And the truth of the matter is, by doing that, God can eventually increase your knowledge and open your eyes to make more money from the market. But if you are the type that doesn't, you don't send people, then they may be wishing you bad luck. That's the truth. And from there, the old bad luck can start happening to you right there, trading. So let's look at how you're going to be managing your loss if you're in a loss position. Now, this one is very, 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 very how will I put it? It's a very tough one. I must confess. I've been in that position quite a lot of time before, and I know how crazy it can be when you are trying to manage yourself out of loss position. So the number one problem many traders face is the emotion derived from watching a losing trade turn deeper and deeper against you. So for instance, you started with $2,000 and now your account is in red. That means you are in negative $1,600, for instance. Negative $1,600. Now it's very crazy because the truth of the matter is you may not get over that loss unless you really know what you are doing. So one, you need to understand and respect the fact that loss is part of the game. And as a matter of fact, there are some times that the loss will happen. And when they happen, you just accept it as early as you can and you move on. But trying to fight back the loss without really knowing what you are doing can lead you to crash your account fast. So sometimes when loss comes, you accept that loss. And the only way to accept this loss is what we are going to be discussing by the time we go back to the Microsoft Excel model, where you are going to be where you determine how much you are going to be losing per trade. Then in the overall, how much you are going to be risking per portfolio of trade. So now what we are going to do is that we know that loss will come. So since we know that loss will come, then we want to apply this insurance rule, the 60-40 equity preservation rule. So what I'm saying in essence is this: when we went to the model, we were able to discover that, okay, if you want to be earning $200 or $250 or $300 per month, then you need to have about $2,000 trading with $2,000. Now, with this $2,000, the 60-40 rule is that you're supposed to take about 60% of this $2,000 to keep, just in case you find yourself in a mess. And you're not going to be keeping it in your bank account. No, you're going to be keeping it at the back end of your broker dashboard. So you only move 1,200. The 60% of 2,000 is 1,200. You move 1,200 into your trading account. And for Forex, for instance, if I put in $1,000, they will give me 30% of that. So they will give me 30% bonus, and I can withdraw. There's no condition to it. I can withdraw it anytime. So if I fund $1,000, it's automatically turned to $1,300. So what it means is that when I am funding this $1,200, that is supposed to be 60% of this $2,000. By the time I take it there, they are going to increase it by 30%. So ultimately, it increases and gets to about $1,600, for instance. It increases to about $1,600. Meanwhile, you still have around $800 at the back end of your broker dashboard, at the back office. So even if when you fund this $800, they will add another 30% on this. So what now eventually happens is that because you know that sometimes you can find yourself in a mess, in a loss, and what eventually used to make some people crash their accounts is margin call. Now, how do you prevent margin call from happening? You prevent margin call from happening by funding more to your account. The only reason why people enter margin call and eventually crash their account is because the accounts, the loss is too much, and the accounts cannot carry that position they are in anymore. But by the time you move in your reserve into your trading account, it gives you more margin. Your margin is going to increase significantly by a certain percentage. It can even increase by 700%. So let's say, for instance, you were on margin call of minus about 90%. You are in 90%, and the margin call will start applying around 50%. But by the time you put in your reserve, that $800 or the 40%, it can take you from this 90% to something around 500%. So it's let you stabilize your account pending the time you are able to think of a way to get out of that loss, which is why it is always advisable that anytime you want to trade, you have a reserve. If you don't have a reserve, don't start trading. That's the truth. If you start trading and you don't know what you're doing, by the time you start looking for money to fund or to quickly put into your account, it may eventually have crashed. So now, after you have been able to stabilize, get the reserve, then you need to now think of where you have gotten it all wrong. That means you review your trade journal. Sometimes it's not that you were actually wrong in your analysis. It could actually be that there was a fundamental news that triggered against you. And it doesn't mean that you were wrong. It just happened, and it can happen at any time. That's the funny thing about fundamentals. Sometimes it happens without any pre-information or whatsoever. So you need to know what happened. Why are you in that state? Is it because you were impatient, as in you quickly jump into the trade without letting the structure complete? Or is it because you got the setup wrongly? If you cannot find out why you actually got it wrong, then there's high probability that you're still going to keep on messing, as in revenge trading. So now you accept the loss. You can accept placing stop losses at levels where it is obvious. If price gets to that level, then the current structure becomes completely invalid. You may have to close some in loss. Sometimes, because you're having heavy load on you, sometimes it is quite, advisable that you reduce your exposure. You close some of the ones that you know that based on that structure, this one are not going to be returning anymore. So you just let it go. Then the ones that are remaining, you try to see how you can avert that position. Now, what you now need to do is that you move your reserve capital to your trading account. We know that sometimes it will come, and if it doesn't come, well, it will still be there in the broker account. Nobody's stealing it. But anytime you now find yourself in loss, you now need to move your reserved capital into your trading account so that your margin percentage can increase. Sometimes it can be in 70% before you move your reserve. And by the time you move in your reserve, you can go to as high as over 500%. So with that, you're not going to be facing any margin call anymore as at that period. That is how to make sure you don't crash your account. As a matter of fact, if you do this and you know what you're doing, there's no way you're going to be crashing your account except you don't know what you are doing. Now, this is where hedging techniques comes in. Now, hedging techniques is actually quite technical. We are going to be discussing hedging techniques in the next class. But for now, that is where the hedging techniques will come in. So let's say, for instance, let me go back to the chart. Let me go to USD card chart. Let's go to the 1 hour time frame. So let's say, for instance, I'm coming. Let me change this to, okay. Let's say, for instance, you enter the trade here. You enter the trade here to sell. You wanted to sell, and this is where your stop loss was. So after you enter this sell right here, price move in your favor a little bit around here, only for it to now start going against you, just based on that one that I used as an example in the slide. So what you are supposed to do eventually is this. If you know that you got it all wrong, and okay, let me remove this so that it doesn't blur right upper trade. No, let me just say no. So this was where your stop loss was supposed to be, and you entered a sell right here. Unfortunately, you did not see this reversal pattern for you to know that price is going to break out of this neckline. Sometimes it happens. So let's say, for instance, after price have broken and got into this area, that is when you now realize, wow, I didn't see this to be inverted shoulder pattern and a neckline and a breakout. Now price is going against me. And you went to the higher time frame, you now realize that it's going to be doing, it's going to be giving you this structure, which we are right now. The price is going to be breaking this top. It's going to be breaking this top. If you remember, I told you guys to first buy USD card at some times, and later on, I told you we'll be selling. So when you realize you were here, and you wanted to sell. So upon selling, you now realize that price is going to be breaking this top. So what you can do on the lower time frame is to eventually edge your position. Edging techniques is a little technical, but you need to know what you're doing before you'll be able to do that. So eventually, what you're going to do is to add another position. So that means that around this point, when price retraces around here, if price retraces around here, you can see that it has given you another reversal pattern, inverted shoulder, head shoulder pattern. We know that this market is still going to sell, but unfortunately, you were selling early. So what you are ultimately supposed to do is to look for a pattern that is going to be in confirmation of that move to the upside. Now, without closing this sell that you have right here, you can enter a buy right here. So you have a sell right here, then you have a buy right here. And the buy and sell can ultimately be in the same amount of loss size, say 0.1 versus 0.1. So within the broker software, it is assumed that you have already closed your position because you are opening and closing a position using the same lot size. So right now, your buy is going to eventually be in profit for about how many pips? For about 200 pips. And after you have gotten to a level where you know that the structure of this will eventually start selling, you are not going to be selling until when you are sure that price will eventually start selling again for a very long time. That is when you can now look for another sell. Now, we'll be looking for another sell around this point, So you are going to be taking another sell around here, and you move the target. This is your target of this of the first entry. You move it to your entry, to the one that was in loss. You move your target back to the entry, and you open another sell around this point. So when price, you've already made a profit around here for the ones that you were in loss, and now you're going to be taking another sell. That one is going to be in profit, and this one ultimately, by the time price gets to this level, it will close you out at your entry. Meanwhile, this one is back in profit. So, but this the edging techniques requires that you know what you're doing. You need to have a very good knowledge of structures. If you do not have a very good knowledge of structure, you are going to keep on compounding to your problem. This is a very good example of how to turn a loss position into a winning position. Does hedging mean you remove stop loss? No. Hedging does not mean you remove stop loss. As a matter of fact, I didn't mention any stop loss here, if you remember. What I said is that let's say, for instance, you were selling here. This was where you were selling. And let's say, for instance, okay, let me talk about the stop loss that you just mentioned. Let's say, for instance, you put your stop loss here. Then something happened. Maybe you wanted to go to sleep and you feel that there may be a stop hunt around here. So you remove your stop loss when you wanted to sleep, only for you to wake up and price has already got into this area. So you waited for it to come down a little, then you are buying. So as at that time, you don't have any stop loss anymore. If you remember, now you're going to be placing a buy around here, you have a sell around here. So no more stop loss. So what eventually happens is that for you to be able to hedge successfully, which is what we'll be discussing in the next class, your SL will need to be tight. So because you are buying here, you place a buy around this point, for instance. If price comes to this level and break this low, then it means that the inverse shoulder pattern is no more valid. So you are going to be putting your stop loss here for this buy that you want to do. The reason is because you don't want to have two loss positions at the same time. So for the other one that you are taking, let's say, for instance, they are not even close. Let's say, for instance, they are here. This is where that one is. For the other one that you have in loss position, you don't need any stop loss anymore for that because price have moved significantly against you. Price is already around the spot. Price have moved to this area. So there's no more putting stop loss unless you want to close it out in loss manually. So, but for the new one that you'll be taking around this spot, your stop loss needs to be very tight. If price comes to take you out in that stop loss, you accept it and you wait for another proper reversal pattern. Let's say, for instance, that has gone and you want to look for another reversal pattern. This also is another inverse shoulder pattern, and here is where your stop loss should be. So the next setup you are going to be taking will have stop loss, and if price take you out, you accept it. You need to always wait for a new proper structure before you take the next position as edge. So for the whole position, I've already explained this one. For the whole position, you move your target to break even. For the new position, your SL will be very tight, but well calculated. Just like what I just explained to you. At this time, you are not to do anything anymore. At least two things would have happened. Is either your new position have been in profits or it has touched that tight SL. One of the two would have happened. So if that happened, anytime that happened, you just need to relax. If it goes in your direction in profit, you just need to relax. You probably will get out of that mess soon. Just like I said, hedging is very technical. So by the time you get to that spot, then you can now look for another reversal pattern to the downside so that you'll be able to close both position in profit, or sometimes if you touch your SL, then it means that you are still doing something wrong. If you have done it 2 or 3 times, trying to edge your position, and markets keep taking the new position out in stop loss every time, then it means you are not doing something right. You need to leave the market and perhaps go back to learning. Now, you don't need to worry about this. We've all been there. I've been there also. And I can tell you, it's usually not easy for you to try to get out of a loss position. Now, the money management and risk management lessons, which is one of the reasons why we are here right now. Now, Forex risk. I'm just giving a definition of what Forex risk is. It's simply the potential loss which happens if price move against us. So that means if you make the prediction that price is going to go up and decide moving against you, then you are in loss, and that is the risk that you are going to be facing. It happens every time. I've explained it before, and it will still happen unless you are not trading. So sometimes price is going to be going against you. But what determines what happened is how you are able to manage yourself at any time that is happening. So now, risk management are actions or strategies and precautions you apply in order to minimize the likelihood of every financial loss. So this is a broad definition of risk management. But when it comes to the Forex market, risk management has to do with how much your returns is able to cover for your risk. In a broad language, risk management actually means the things that you are going to do in order to minimize every financial loss. Yes. But in the context of Forex, risk management has to do with ensuring that your reward is much more large enough to cover your risk at any particular point in time. So first, we are going to be looking at the strategies you'll be using. Then later on, we'll go to the risk management techniques. So one of the things we do is the stop loss. I don't need to talk about stop loss. We've already, we know what stop loss is. Almost every one of us here knows about stop loss. Then hedging. Hedging is also another way of preventing every financial loss. In the example I told you right there, you were selling, then price started moving against you. Now you understand that you did not see the inverse shoulder head shoulder pattern that triggered before you started before you took the sell. So you can decide that, okay, when price pull down, I'm going to be taking another position for buy. So you can be taking a buy right here up until when price gets to the level that you're going to now start the overall reversal. Then from that point onwards, you can now start looking forward to sell from there. So this one will be in profit. This one will still be in loss. So, but if you get it right, this one will be in profit and this one will be closed at your entry, while this one will be closed in profit also. So you can turn a loss trade into profit, but that requires good practice, good knowledge, and having control over your emotions at every particular point in time. The money management. Money management is what we are going to be talking about right now. But before we talk about the money management, we are going to be looking at the ideal risk management protocols. So the simple definition of money management is capital preservation. Any English anybody wants to start talking about doesn't really matter. What matters the most is that you have decided that you are going to preserve your capital. You are going to be preserving your capital and you are not going to lose it. So in order for you not to lose it, there are some certain things you need to ensure. So it means you have made a decision to not expose yourself to unbearable risk. That means that you, if you are going to be in a loss, it is a loss that you can afford to let it happen. Unbearable risk means that if that kind of loss happen, you may even go and commit suicide. You don't want to put yourself in that kind of tight corner. Not at all. So if you cannot win, then you should make sure you don't lose at all. Still be around your equity and your capital level. So we are going to be looking at the money management and the risk management techniques. For the money management, you are not supposed to risk more than 1% to 2% per one position when you get a good entry. Now, if it's going to be a very, for me right now, I do 3% sometimes. It depends on the structure that I'm looking at. Now, for you that you are just starting, you are not supposed to go more than 1 to 2%. As a matter of fact, I'm going to be advising you first use 0.5% and 1%. Then after you keep on getting more comfortable with the market, you can increase it from that 1% to 2%. Then later on, by the time you get to the pro level or thereabout, then you can now start using 3%. Ideally, it is not advisable to go above 3% unless you are all the same sniper trader that doesn't follow money management rule at all. Then if you are using 0.5 to 1%, by the time you pack all the portfolio of trades together, they may most likely not be more than 5% of your account. So that means that if you are trading with $1,000, for instance, if you are going to be losing at all, you may just lose $50 if you have ensured adequate money management. That means you pack 0.5% of trades, about 10 trades of that using 0.5%. And at the end of it all, by the time you add all the risks together, it's not going to be more than 5%. But if you are using 1% per trade, for instance, then it means that by the time you pack about 10 trades together, you are not taking trades more than 10% of your account, which is $100 if you are trading with $1,000. So what this means is that if there's a very sad day, a very bad day, and the worst happen, you lose all your positions. Maybe there was a news and you didn't do currency correlation and you pack highly positive correlated pairs together and fundamentals happen and it went against your trade and you lose all the 10 trades. The highest that would have happened is that you'll have lost 10% of your account. But if you know what you're doing, the 10% loss can eventually start building up into profit later on. But at the very worst case, it should be 15%. Now we are going to go to the model and we are going to see how we are going to determine every risk per trade, which is one of the things that most of you Forex traders ignore. As a matter of fact, the most important part of trading is money management and risk management. I won't lie to you. The most important part of them. Go and talk to people that have traded, successfully right there in the Forex market. They will just tell you to work on your money management and risk management. It doesn't matter how much knowledge you have. If you are not able to follow the money and risk management, you may not be successful trading the Forex market. So we are going to be going to the Excel model to determine how we are going to be calculating this risk per trade and per portfolio. But for the risk reward, what we are saying is this. At any time that you are taking a trade and your risk versus your reward is just 1.5. That means 1.5 means that if you make a profit, let's say, for instance, you are risking $100. However, when you want to set your target is $150. So this is 1 to 1.5. That means 150 divided by 100. 1.5. So your risk reward is 1.5. So if most of your positions are usually 1 to 1.5, your portfolio, your risk level is actually fair. That is what it means. It means that you are not ensuring adequate risk management. But if your risk management, for instance, if your risk reward is about 1 to 2 or 1 to 2.9, that is in the range of 2 to 2.9, then it is good. So it means that at any time that so let's say, for instance, you are risking $100 per trade, However, by the time you want to make profit, your profit is about $250. So that is 2.5. So it means that anytime you are making profit, you are making more profit than you are risking it. We are going to see the effect of this later on, how it's going to eventually turn you to be a profitable trader, even if you are not very, very good at picking good trades. But if you have a risk reward that is 1 to 3 to 3.9, that means they're greater than 3 and about 3 to 4, then that one is very good. As a matter of fact, I would advise that you play around a risk reward of about 3 to 3.9 most of the time. If you look at most of the setup that I usually post to you guys recently, I used to post the risk reward there. So some people used to ask what I mean by all this RR that I used to post. It's for your knowledge so that you will know if, for instance, your risk, you have a trading plan and your trading plan says that you're not supposed to take any risk reward that is less than 3. So this kind of a trade that I posted, for instance, this one that is 1 to 1.8, you are not going to be taking the trade because your trading plan says don't take any risk reward that is less than 3. But if it's about 3, then look at this one. The risk reward is 3. That means if you are making this gain, you are going to be getting 3 times how much you are risking. If you are taking this trade, you are going to be getting 3.1 times. So sometimes what I do is I usually ensure that anytime I want to send a signal, I try to look for a setup that is at least 3.1 to 3 risk reward. And we are going to see the reason why this is very, very important later on. But if you are able to get about 1 to 4 risk reward and above, very awesome. If you are able to get 1 to 6, in fact, you hardly see someone that will be getting 1 to 6 risk reward or 1 to 8 risk reward. Market may not move much more like that. It happens sometimes, but it is not common. The one that is common is usually around here. Around here. Most of the time, this one, but this one is where you are supposed to tilt towards. So you don't get greedy. You should try to take profits at when market has moved 50% in your favor. So that means if you are taking if you are targeting $200 and price have started moving in your favor to $100, then you close out of your position and you move your stop loss to break even. Then when market has gotten to another predetermined level, maybe about 2, is now 1 to 2 or 1 to 2.5, and you feel that price is still going to move in that favor, you close some of your profit also. Now let's go to the chart and the Excel model and see the reason why we need to always ensure risk reward, adequate risk reward. Now, what this model is saying, I've already done this presentation to you guys before, but it doesn't matter. I will still explain for those that were not part of it. So what this model is saying is, let me quickly explain what this model is all about to you. Capital at risk means, okay, if you pack all the portfolio of trades together, let's say, for instance, you put in Euro USD, you are buying Euro USD, you are buying Euro JPY, you are buying USD card. By the time you add all the risk together, you are not risking more than 10%. It is not 10 per one trade. It is 10% in all the total trades that you have taken. Now, you as a trader may not be able to know or may not be able to quantify how much you have risked. In fact, a whole lot of us just enter trade. We don't know at what risk level am I. It is when prices are moving against you that you start panicking. But this model that I'm going to explain to you guys now, this one, this will let you see how much you are going to be risking per trade. So by the time you want to take a trade, let me see if I can quickly open a demo account and see if it's going to apply the risk management stuff to it. Let me try search for a parry. I think that one is usually very easy to open a demo account. New demo. Maybe because market is closed, it's not opening anymore right now. But I'll come back to it. I think I should have one or two so that we'll try to see a practical example. So let me go back to the slide. So the model will help you calculate. That was why I took the pain to go and build that model. It will help you calculate how much you are risking at the particular point in time. Then it will also let you calculate how much risk you are taking per trade. Then it will also let you know how much risk reward you are taking per trade. But before we go to that, let me quickly explain this to you. So what this one is saying is this. Let us assume that we are not even very good enough. And our strategy, by the time you backtest your strategy, is only giving you a 34% win rate, which is very, very poor. Very poor. That means that if you take about 10 trades, you are going to lose more than 7 of them. You are going to just win about 3 of them. But yet, what this is saying that by ensuring a risk reward of around 3.4 or thereabouts, you are still going to be making profit at the end of the day. You can see the profit around 34% profit. Now, most of you out there, you are always looking for a trading system that can give you 80% win rate, 90% win rate. You don't think that for you to be a profitable trader. No. In fact, you only need about 40% success. But if you now ensure that you are not paying attention to what you are supposed to pay attention to, you are complaining about the trading system. Meanwhile, you are paying attention to a trading system that should give you about 80% or 90% and not following the adequate risk reward. That is why I've decided to just make this to be general to every one of us, especially because some of you used to follow my trade signals, and sometimes trade can be going against you, and you start wondering or you start fretting and all that. Meanwhile, you have not really considered the fact that every position asks a risk reward. That means if you are going to be losing one and you are going to be winning one, the one you are going to win will ultimately pay back the loss you are going to make. You are going to experience. So what this one is saying that we have about 9 trades right here, and out of that 9 trades, 1-to-1 risk reward, you only took just one trade that is 1-to-1. Now, you took two trades that is you took one trade that is 1-to-1. You took 3 trades that is 1-to-2. That means out of those 9 trades that you took, 3 of them have 1-to-2. However, 3 of them also have 1-to-3 risk reward, and 2 of them have 1-to-4 risk reward. At the end of the whole period, by the time you do the average of the risk reward, you're actually having a risk reward of 3.4 in your total portfolio. So with this, so what this model is now saying, let us look at this. So you have an account balance of $1,000 that you are trading with, and you have risked 10% of your account. So that means if the worst thing happens, you are going to be losing $100. But we know that we don't have 0% win rate. We have 34% win rate. As a matter of fact, some people's strategy can give them 60 or 70% win rate, but yet they are still not going to be making profit. Now, what happened right here is that we just have 30% win rate. That means if you take 10 trades, 7 of those 10 trades, it's stop loss. That is quite crazy. 7 out of 10. I'm sure that majority of you, if you take a trade and 2 or 3 start hitting stop loss, you start fretting and you start complaining bitterly about your trading system. The truth of the matter is that if you are consistent with ensuring the adequate risk reward, it doesn't matter. At the end of the period, you are still going to be making profit. Now, 70 hits your stop loss. That means you have lost $70. And 7 hits your stop loss. It means you have lost $70. However, 3 hits the target. Now, 3 times 3.4 is what's giving us this 103. The 103 minus the $70 that you lost still gave you a profit of $33. That is why you realize that this is why I have this table. And it is that same indicator that I showed you that will give you that statistics. So as at right now, it means that I'm risking about 16% of my account, but my risk reward, I've ensured that the risk reward is 3.5. So even with that, but with this kind of trading system, with my trading strategy, I'm having how many win rate? How many win? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of 12. 10 divided by 12 should be how much? 10 divided by 12. Mathematician in the house. 10 divided by 12 will be something around 80%, about 83%. So, but however, for me to be profitable, for me to even make profit at the end of the day, I only need about 30% win rate. And yet I'm having around 80% win rate. So we are assuming the worst case scenario right here, right now. That, okay, what if 7 hits your stop loss and just 3 hits your target? You still make profit. So on the second trading period, you now have a balance of $1,032 and you just add 20% win rate. That means a whole 8 hits your stop loss and just 2 hits your target. So if 8 hits your stop loss, you'll be losing around $83. However, the win, because you are ensuring the adequate, the weighted average risk reward, you made $71 from there. By the time you do the plus and minus, you have just lost $12. The same thing happened on the third day. You lost $12. But on the fourth day, 7 hits your stop loss again, and only 3 hit your target. You still make back the 3. You can see that the equity curve keep on increasing. Look at the equity curve. It keep on increasing steadily from that 1,000 to 2,500. So sometimes it is not really that your trading system is wrong and you're focusing on the wrong thing. What you should actually focus on is always ensuring that your risk reward is adequate. As a matter of fact, what I now eventually did was to do a sensitivity analysis to try to find out at what point, let me increase this, to try to find out that at what point are we going to start losing if you are not if you are following certain risk reward ratio. Let me try to do this and increase it. Yeah, I think it should be bold enough now. So what I'm going to do right now is that I'm going to run the simulation, and you guys should keep on looking at this risk reward ratio and the percentage gain or loss. If you want to test a system, you need to test it over about 1,000 times. You just keep on running it, and that's what this model is doing. The model will keep on changing. It will keep on changing this risk reward. Let me reduce it back so that you try to find out, try to know what the model is doing. It will keep on changing this different risk reward, and it will be putting the results here. The results that you have here, it will be putting it here. And it will now be applying it for different risk reward ratio. So you realize that if you are just taking a trade that is based on 1-to-1, each time you are taking a trade and you have this terrible win rates, you are going to be losing. But if sometimes you are ensuring 1-to-2 or 1-to-2.5 or 1-to-3, 1-to-3.5 or thereabout, sometimes you'll be making losses on this place and sometimes you'll be making profit. But from these 3 points above, you realize that you are not going to be seeing red there at all. So I'm going to be running a simulation right now, and you see what I'm talking about. You can see that it is changing, and you can see that right here, it means that we may have actually lost 5% by just ensuring 1-to-2 ratio. But if we are ensuring 1-to-2.5 or 3, we'll still make profit. I'm going to keep on running the model. As you can see, the win rates keep on changing here. The risk reward keep on changing here. The amount of trades keep on changing here. And as a matter of fact, all this table also keep on changing here. And just look at this point. You see that there's no point at any particular point in time that you will see red on this 1-to-3 risk reward. If I keep on pressing the, let computer just keep on running the simulation, you'll see that even if you are going to be having red occurring on this 3 at all, it can just be a one-off period, maybe one time. But hardly will you see red appearing on this 1-to-3. So it lets us, what this one is now letting us do is to let us know that if you want to be consistent trading the Forex market, you need to ensure that your risk reward is usually about 3. That means that anytime you are taking your target level is 3 times of your risk. Now, this level, this one right here, is where is what let us know what amount of risk are we going to be taking based on a setup? I've already taught you guys Elliott wave, harmonic market structure, all of these things. Now, my own trading strategy is usually the combination of one or two or all of all these things. Now, it's going to be very difficult for you to have a setup that have all these things together at once. But for someone like me now, I have an harmonic software that I use that scans. I have knowledge of Elliott wave, market structure, divergence, and a whole lot of all this. So what eventually happens is that if you see a structure and you have done the Elliott wave analysis, if you click on yes, for instance, you can see that it has turned into 2. So what the key to this one is that if the risk score is less than 3, then it means that that setup is bad and you're not supposed to take it. But if the risk score is about 3 to 4.5, then it means that you just average. You're supposed to risk just 0.5% of your account to take that trade. If the risk reward is about 4.5 to 5.9, then it's just fair. You are just supposed to risk 1% of your position. That means that it's a 50-50 chance, so just risk 1%. But anything above that, 6 to 8 risk score is very good. You can risk 1.5% of your account. Then greater than 8%, you can risk 2%. As for me, I used to risk about 3% right here. So how do you get that? So if you have done your Elliott wave, you can say, okay, I did, then the harmonic pattern also happen around that. But if yes, then you say yes. Then you can see that this one is increasing already. So it's telling you that, okay, you can risk 2% of your account on that trade. So for instance, you have a $1,000 account, then it means that you are probably supposed to risk 0.03. Some people, because they have $2,000 in their account, for instance, they would eventually start using 0.2. No, it depends on how much you are risking, the size of your stop loss. If your stop loss, the higher your stop loss, the lower the risk that you are going to be taking. So if your stop loss is $150, for instance, you can see that the Excel is telling you to risk just 0.03 loss size, to use 0.03 loss size. If your stop loss is just 45%, let me just use 30 pips, then that is when it's saying you can reach 0.13. Your account size determines the loss size. Your stop loss, the stop loss per trade. Let's say, for instance, I put 250 here. Despite you having $5,000 to trade with, but because for that trade, you are risking as high as $250. For you not to risk more than 2% of your account for that particular trade, you are supposed to use 0.04 and not 0.3. So this is some of the things that you guys do wrong and you don't know. You are just taking trade without really basing your knowledge, without having any basis on taking the trade. You just feel because you have $5,000, you can use 0.5. You can use 0.3 on a particular trade. By the time you quantify that 0.3, it's about 10% of your account because your stop loss is good for that particular setup. So if you want to be doing this by yourself, it's going to be very tedious, which is why eventually I decided to go and build a software. Now the software is going to help you to be able to take the trade. I'm trying to see if I can get to C1 297-25233. Let me see if I can get to quickly open one demo account and see. Just give me a minute. Let me try to see if I can open one demo account and apply that software there. Then we'll see how the software will calculate how much you are going to be risking per trade, and it will also add how many all the risks that you are taking together. It will add them together for you to know how much risk you are currently on, so that you don't keep on taking trades and hardening them unnecessarily. So, let me go to this last one. The last one is the trade journal. Now, what I eventually did was to go to look for somebody that can build what I want. So I explained this to them. This one that I just explained to you, I explained this to them, the whole concept of this to them. I explained the whole concept of this to them. Then I also explained the whole concept of this trade journal to them. So if my accounts right now, if I change this one to 10%, for instance, or let me use 11. you can see that it has turned to orange. It was initially light green before. If I change it to 5%, or let me use 4%, you can see that the green is very big. But if I change it to 7%, it is now light green. If I change it to 11%, it is orange. If I change it to 17%, it is red. So what it does is that it calculates the risk and the total risks that I've taken, and it sums them up. All these risks, 1%, 2% that I'm taking, it sums them up. So by the time I am already 17% in total position, it turns to red for me to know I am already over leveraged. That means I've taken too much risk. So, you know, I told you that the ideal risk is about 5%. Then tolerable level is about 10%. Then more than that, that means about 15. Maximum is about 15%. Anything above that, it means that you are actually taking too much trade. So I have opened this thing right now. Let me share it. I've opened this right now, and if I want to be selling this position right here, let's say I want to sell it. All I just need to do is just click on flip, and what you will look at later on is that you will realize that there is something that will be moving. Let me try to reattach it. So you realize that there's something moving. You see that at each time that I'm moving the stop loss, the lot size keep on changing. Look at this lot size. You see that the more you are increasing your risk, the lower your stop loss should be. The more you are reducing your risk, that means the lower your risk, the higher the stop loss should be. If you go to the setting, you will see what I put there. What I put here is preferred risk per trade, 3%. So for you right now that you are just beginning to trade, you can change this one to 0.5. That means you just want to reach 0.5% of your account. Then right here, you can see that, okay, when my risk level is 50%, is 5%, that's my normal risk. If it is 10%, then that is the moderate risk. But if it is greater than 15%, then that is the high risk. And the maximum total risk of equity is 15%. So once you put it there, by the time you keep on taking a trade and you have gotten to your normal risk, it will alert you that you have risked 5% of your account. If you get to the 10%, it will alert you that you have risked 10%. If you get to the 15%, then it's going to shut down. It's not going to work anymore. So by yourself, you can decide you want to still take it, and you use a manual way of taking it, but the EA will not work anymore. Then another thing it does right here is that it moves the stop loss to break even at a predetermined level. So for instance, I can say that anytime price have moved in 85% in my favor, even if I am sleeping, it should just move that pips, it should just move that stop loss to my entry. It will do that for you. Then it also lets you open TP1, TP2, TP3. Somebody asked me a question at one time. I'm going to be canceling the right now. Okay, let me click on OK. So somebody asked me a question. You can see that when I change it to 0.05% per risk, it has reduced this one to 0.03. Before it was 0.13, but because I just want to risk 0.5%, it's I've reduced it to 0.3. If I increase it significantly, then the minimum is 0.01. So no matter how much you increase it, the minimum is going to get to is 0.01. Then somebody asked me a question one time that what if when I post TP1, TP2, TP3, how do they do that? Especially when you are going to be sleeping and you don't know when the TP1 can hit to close half or whatever. Now that is what this EA also does. So if I want to do TP1, TP2, TP3, for instance, for this sell trade, it's going to now open 3 positions. Now in this setup, it's going to ask you that should this split risk for multiple targets. So that means that if you want to risk, let's say for instance, I put this one to 1% so that we can understand. Now, if you have a setup and you see that the setup you want to be risking 3%, let me go back to this. You want to risk 3% for that setup. And you can see 3 levels at which you want to take your profits. So what this one is saying is that anytime you click on this add, is this going to split this 3% into 1%, 1%, 1%, or should we leave it as 3%, 3%, 3%? So what eventually you should do is that if you do not want it to split it, that means you don't want this to be splitted at all each time, then it means that your risk most of the time should be left as 1. Then that's when you can take this one to be no. So that each time you are taking a trade, it only risks 1% for that trade. But if you see a good setup and you feel that you want to reach 3% for that setup, so the fact that I'm taking 3 trades doesn't mean that I'm taking 3 trades. I only split that 3 trades into 3 of 1% each, and I'm not risking more than 3% despite taking that 3 trades. So if I say, okay, split it, I'm going to put this one as 3%, and I'm saying anytime I want to take multiple trades, then split it. So you click on yes. So by the time you click on this right now, you'll see what will eventually happen. So if I click on, let me say for instance, my first target, I want my first target to be hit here. And I want my second target to be hit here. You can see that, let me remove this so that you see what I'm talking about. You see that before I click on the add, it's telling me that if I just want to take 1 trade and I'm risking just 3%, based on this, let me increase the stop loss to this one. So based on this entry level, based on this stop loss that I'm putting, and I want to risk 3%, then I'm supposed to use 0.12 lot size. But if I am going to say, okay, I want to take 3 trades or 2 trades, for instance, by the time I click on add, you can see that it has split that 12 into 2. So right now, I can say, okay, the first target, I want it to be closed right here. And the second target, by the time it gets to this level, I want it to be closed. Then I can also click on, okay, add another one again. So it's now 0.04. That's 0.04 in 3 places. So by the time you had all the lot size of 0.04 in 3 places, it goes back to 0.12. And that's just 3% of your risk. So it's going to open 3 trades, and all the 3 trades will be closed by the time market gets there. So you can set it and go and sleep. So right now, if market is open and I click on market, so there are 2 ways to it. If you want to it to be pending order, then you can move this to this level. I mean, you feel that price is still going to come up before you take the trade. So you can move that to up and click on pending. So it will open it as a pending order. But by the time if you want it to be market order, you move it. It doesn't matter where you move it to. Once you click on market order, it opens the price at the current market level, and it opens the 3 positions. That is what I used in giving you guys signals, where you used to see the TP1, TP2. Immediately I click on market, it will copy all these trades set up on the clipboard, and I'll just send it to you guys. So some of you guys will now start wondering, how will you do it? How do you do the TP1, TP2, TP3? Eventually, you are even using on $200 account size, and you're already using 0.01. So when I'm now saying close half of your position when price gets to TP1, you don't even know how to, you cannot close because you're already using 0.01, which is why you need to first have the right trading account size, so that by the time you are trading using multiple levels of targets, you'll be able to use the right account. Despite the fact that this this demo is about $3,000, the lot size for use based on this risk right now is just 0.04. Now, at the end of the whole period, if you want to see how much you have made over the period, as in you want to see the statistics of your trade, you can now change it. You can now come to this lower part and you click on, okay, you come to this higher part and you click on history, information panel. So you are not actually looking at trading with the EA. You want the EA to give you the statistics of the position that you have taken for you to know the risk reward that you have and all that and all that. Once you click on it, it will open this table. Once you click on that information panel and you say, okay, it will open this table for you, this one. It will give you all the positions you have taken, the lot size, the risk reward for that position, how much risk you took. For this one, I took 3%. For this one, I took 1.3%. When you move your stop loss to break even, it means you don't have any risk anymore. That's why you will see 0 right here. Then It will let you know how much profit you're making in dollars, then it lets you know how much pips you're making, then the percentage of gain you are as at any particular point in time. Then it will also show you the statistics of your position over a period of time, yesterday, today, last week, last month, and all that. So if you so that just summarizes all the information I get for you guys. In the next class, we are going to be discussing geometrical trading system. I don't think I will talk to you guys if we can still have it today, or we postpone it to maybe on Monday. I think there's still a holiday on Monday, but the next class is most likely going to be the final class. Then I will leave you guys to practice, and if you have questions anytime in the group, you can chat me up. I don't know if anybody have any question. If you want to ask me a question and you want to talk, then make sure that you are in a quiet place. Okay, the next batch is going to be starting next month. Kelly, the next batch is starting next month. Can you share the Excel? I can share it to my student, but not to just any other person. Any other question? Yes, if you want it to work offline, then you need a VPS. For you to you need a VPS if you're going to be working offline. Any other question? Is there any other question before I close this session? Then I can decide to take the geometrical conference strategy with my students alone. If there's no other question, then I think I'll just end this. I think I'll just end this right now. If you want to become my student, you can chat me up on WhatsApp or Telegram. You can chat me up. The name, I'm still building my own harmonic software. It's not completed yet, but when it is completed, it's going to be available on the website, the Club 9 Forex website. There's a website that I'm currently working on right now. I'm sure you guys have been hearing about, but it has not been operating yet. This is the website, and by the time it is concluded, you guys will I'll let you guys know. So the essence of the website is for us to be able to analyze the markets together, and we'll be hosting webinars for us to be able to spot the probability, these high probability setups, signals, and a whole lot of things. So you can add your trade idea. For instance, if you want to, just the same thing that we are doing on the WhatsApp group or the Telegram. If you want to add a setup for the community, just click on Add Trade Idea. You select the currency pair, buy or sell. You put the signals there. Once you put it, it is available for people to be able to see right here. So people on the community group can get access to free signals or paid signals. Those that want paid signals will go to the Elite room. Then the next batch is going to be the last. The next batch of training is going to be the last batch of training, after which I'm going to be doing recordings of the training and putting it under this Forex Academy. So anybody that wants to get trained can go there and watch at any particular point in time. Then the good thing about this community also is that you get rewarded for some of the services. For instance, if you bring someone in and that person gets a plan, gets to be part of the Elite room, then you get about 35% or thereabout of that cost. And it's not going to be bring two people, all those kinds of things. No, it's just a flat amount. You bring somebody, you get compensated for it. So it doesn't matter whether it's 2 people or 10 people. Just bring in anybody, you get compensated for it straight up. Then we are going to be having weekly periodic webinars around here, and this is where it's going to be displayed. So what I'm doing right now, we are still going to be having to do it more often after some time. So any question again before somebody is asking to take the trades in an account size of 500 is still manageable. And the truth of the matter is that the trading with an account size of $500 is not, you cannot apply money management rule on an account size of $500. That's the truth. So I can't guarantee that. For instance, let me go back to that Excel model and you'll see what I'm talking about. Where's the Excel model? Let me go back to the Excel model and I'll put $500 there. If I put $500 here, you'll see that at any particular point in time, it's telling me to use 0.01. So if you want to risk 3%, for instance, if you want to risk 3% and you have $500, that means that you'll be risking 0.01 in 3 places. It is no more 2%. It is actually now 6% of your account. So that's why it is not $500. You can't apply money management on it. The $100, there's nothing like $100 trade. If you want to trade with $100, then you go for sniper shot. That means you don't apply money management. You just enter the trade. If you make it big, you make it big. If you lose it, you lose it. There's no money management you still want to start applying on $100 because the base lot size is usually 0.01. And 0.01 on $100 is about 10%, depending on the risk. So by the time you're putting 0.01 and you're taking about 3 or 4 trades, you're already risking about 40% of your account. And ultimately, after some time, it crashes. And that is the ideal. The ideal right there is $2,000, and you're going to be having a reserve. Even at that, you're going to be having something like a reserve. So it doesn't mean that if you don't have $2,000, you cannot trade Forex. No. It just means that if you don't have that kind of money, you cannot apply adequate money management. That is what it means. So if there's no other question, or if you guys still have any question, you can chat me up in the group. So I'm going to be ending this training session. Then I will have a discussion with my students if we can still have a class today, or we have it later on. So cheers to you guys. I'm going to be uploading this record on the recording on the YouTube, so that if you guys want to watch or share with some people, you can also share so that they get to understand the whole concept of risk management and money management in Forex trading. So you guys enjoy the rest of your festive period. I've not seen my chicken or rice or Bitcoin, nothing. You guys are just enjoying alone. It's all good. My regards to your family. Cheers and bye.